Hi everyone, thank you for listening to this short 10-minute recording today. We're just doing a half-year update with Ian Slattery, who's an investment manager with Zurich. Just to mention that we've just recently launched our Savings and Investment Club, which is a savings and investment plan through Zurich Life. We've been working with Zurich for many years now, and I'm pleased to say that we have over 500 clients with over 60 million euros of investments that Zurich are managing. Ian's going to, I suppose, do a quick Q&A with me. We had a few questions that have come up over the last few weeks. So without further ado, I'll start by asking Ian my first question, which is basically that 2020, Ian, was a surprisingly good year for markets, given, I suppose, what happened. I just wondered if you can give an indication of how this year has panned out so far.
Yeah, certainly. And hi, Nick, and thanks for having me. So yeah, all things considered, it was a pretty good 2020 in the end. And actually, that kind of good news story has kind of continued into 2021. So I'm just going to share my screen for a couple of minutes just to show a few slides on it. So if I'm looking at the story of the year so far for stock markets, that's what I have up here at the moment. So you kind of see that almost perfect 45-degree angle line that we'd all love to see all the time for stock markets. A bit of a blip at late January, again in February, and volatility along the way. But stock markets up 16.5%, 17% for the first 6 months of the year. Really, really strong period, well above historical averages. And as you say, Nick, that followed on from a very strong recovery and a strong back end of 2020. So for people who've taken risk, they've certainly been rewarded in the short term in this case.
And Ian, can I ask you, what have been the main drivers for this performance, would you say?
Yeah, it's interesting, isn't it? Because we can sometimes see a disconnect between what we feel locally or in our own jobs and families and households versus what's happening in the stock market on a greater sense. So a couple of things we've identified in Zurich, I think it's firstly, the policymaker action has been really, really important. So when I say policymaker action, think about fiscal policy, government spending, pandemic, unemployment payments, that sort of stuff everywhere, not just in Ireland, particularly in the US. And on the other hand, you have monetary policy. So think central banks, think interest rates, that piece of jargon that's entered our vocabulary in the last 10 years, quantitative easing, all that good stuff. So the policymaker response has been really quick and really, really strong. The second and third points is I'll kind of take them together. The vaccine rollout certainly stumbled a little bit at the start globally and as well in Ireland, but that's really gathered pace and accelerated in recent months. And that kind of comes with an easing of restrictions. So as we know in Ireland, the easing of restrictions isn't always a straight line in terms of the plan, but the more people who get inoculated and are fully vaccinated, and as restrictions are eased, you see economic activity come back, you see economic growth come back, and that's good for risk assets. And the final point is that there's an expectation that there's a pent-up demand in the consumer. So some people haven't done well throughout lockdown, and I think that's worth noting, but other people have been able to save quite a lot, are able to put a little bit of money aside, and that money can go into risk assets, it can go into the economy as well. So a couple of different things that have contributed to that positive growth story.
Very good. And Ian, you keep hearing that bonds haven't been performing so well. Can you explain why? And also, does this change the conventional thinking about de-risking when it comes to bonds?
Yes, there's two very pertinent questions there, and I'll be as brief as possible. I could keep you for hours on some of this stuff, but this looks like a busy chart, but bear with me. I'm just showing you bond yields in the US and in Germany. So as a bond yield goes up, its price goes down. They have a negative relationship. So as you see these lines on both charts start to tick up a bit, that means that bonds are losing money. So why that is happening is to do with inflation expectations and future interest rate expectations. So that can be bad news for bonds. So bonds have lost a couple of percent or even more so far this year. Now, 6 months is a relatively short period of time, but to your second point, I do think potentially the way we interact with bonds in investment portfolios and in a financial advisory perspective may shift into the future. So I think people who might be de-risking to bonds or might want to be in bonds for the long term, it might be worth having a chat with yourself, Nick, or someone else in the team about what options they may have into the future.
Thank you. And what do you see as the big risks out there at the moment, Ian, in the stock markets?
Yeah, so when I look at that first chart, and I mentioned the dips we saw in January and February, for example, they were pretty much based on shifting inflation expectations. And I mentioned inflation in the last slide about bonds. So it is a big ticket issue in the market, or item for discussion at the moment. I won't go through this chart in great detail, but what I'm essentially showing is that inflation in the blue line, which is developed economies, and the red line, which is emerging economies, it's going up. So that impacts different asset classes in different ways. It can be good for equities depending on the pace of change. It can be bad for bonds, and it's definitely bad for cash and people with money on deposit. So as people's expectations of future inflation change, the market needs to digest that. And if it happens too fast or in a slightly different way, the market mightn't like that. So that's a big risk at the moment. We don't personally, or as an investment manager, don't believe it's going to derail equities, but it's a big talking point. The second big risk that we would see is we've got fairly lofty expectations for economic growth at the moment, based on some of the factors I said earlier. So there's a chance we don't reach or exceed those expectations, which could hurt equities as well. But look, there's always risks. It's kind of part and parcel of investing in the stock market.
And one of the questions we're often asked, Ian, is what are Zurich's outlook for the rest of the year?
Yeah, so in a sentence, we're positive on risk assets. So a lot of the stuff that I said was behind why we saw a rise in the first 6 months of the year. They're still there. They're still intact. They've not gone away. The helpful policymaker backdrop, the pent-up demand, those factors are still there, which is positive for equities. I use this phrase relative valuations quite a lot. So we're looking at the different asset classes you get in a multi-asset fund. We believe the risk reward trade-off from equities is better than what we might see from bonds or cash. So we prefer equities on their own absolute basis, but definitely when we look at them versus different asset classes. So that all boils down to being above average in terms of our equity content. On the left-hand side, I just have the kind of tick box matrix that we publish every month for people who want to kind of keep up to date with it. And just a little bit more on our geographical preferences. And we also do prefer corporate bonds over government bonds at the moment. I will say, as an active manager, we move in and out of these different asset classes in different areas. So that can shift over time. But as I said, the summary would be we're still broadly optimistic and positive on the global economy and therefore risk assets.
Very good. And I suppose, Ian, the final thing, would you have any advice for investors at the moment, or any thoughts that you can share with us?
Yeah, I think you and I will change, the market will change. What changes the market will change over time, but there's good investment principles that have stood the test of time. And I think what we saw in the first half of 2020 is a great case study for staying disciplined, sticking with your plan, engaging with your financial advisor, keeping your time in the market, having a diversified portfolio. So we stick by these principles as an investment manager where they're applicable, and we certainly believe that people should take heed of it as well. We don't believe there's a substitute for good financial advice in the market. It's a simple thing to say, but it's worth reminding people of it at the moment. So those long-term investment principles rarely shift in my personal opinion.
Very good. Well, listen, thank you very much for that kind of bite-sized I suppose summary on the half year and obviously for the next 6 months. Hopefully it will be very beneficial for all of us, and thank you for the great work that you're doing in Zurich. So everyone, thank you again for your time, and we look forward to speaking to you again soon. Thank you.
Thank you, Nick.